With AT&T about to reorganize and decrease its dividend, many eyes have turned to Verizon as a similar investment in the same sector with a more stable dividend. The role in a portfolio that I'm talking about for this kind of stock is for a high yield, safe, steady dividend stock that grows a little each year. Let's see if Verizon can fill that niche. And hey, if you like this content, please click the thumb up button, subscribe to our channel, and ring the bell for notifications about our new videos when they come out. Thanks. Verizon Communications is a holding company that is one of the world's leaders in technology, communications, and infotainment products and services. Its customers are consumers, businesses, and government entities around the globe. As dividend growth investors, we're interested in Verizon's dividend stream. Verizon is a high-yield, slow-growth stock. Its most attractive dividend features are its high yield at 4.5% and its very safe dividend. On this display, you can see that the yield on the top line and this dividend safety score on the bottom line both get dark green. Excellent grades. It's called excellent for the yield and called very safe for the dividend safety score. Everything else is okay. Overall, I give a dividend grade to Verizon of B. If it had a faster growth rate, that would creep up into the B plus or A minus category. I realize that Verizon's dividend growth rate at 2% a year would be considered too slow by many investors, while other investors, including myself, are fine with that growth rate in exchange for Verizon's 4.5% yield and very good dividend safety. Verizon hasn't announced its dividend increase for 2021 yet. That should be coming up within a few days of when this video is posted. I'll be surprised if it isn't around 2% again. I'm not going to go into great details about Verizon's various businesses and its customers and so on. I'm just going to display this business quality summary for Verizon, which is very good. In it, I use my 5 quality snapshot ratings coming from sources such as Morningstar, Standard & Poor's, and Valuation. And you can see in the right column the interpretation are that Verizon gets either the highest grades or the second highest grades in 4 of the 5 categories or metrics that I use to describe business quality, and it gets an okay grade in the other one. Overall, on a point system, I would rate Verizon as getting 21 out of 25 points, which is a very good quality grade, B plus in this case. Let's move on to Verizon's financials. Verizon reported its second quarter results on July 21st. It registered beats above analyst expectations on both revenue and earnings per share. We saw earlier that Valuation assigns its highest financial strength rating of A++ to Verizon. They also consider Verizon to have the strongest financials among its 10 peer companies. Here's a summary of some of the most important financial metrics for Verizon. This is my financial summary for Verizon, summarizing several of the most important financial aspects of the business. Revenue has shown a slow, steady increase over the years, and it has completely recovered from a drop that it took from the pandemic in 2020. Verizon is a highly profitable company, and I will show that to you in a second after I finish speaking to this display. Verizon carries high debt. Its debt went way up in 2014 when it made the investment to purchase the entirety of the wireless business that it formerly only owned part of. In the years since, it's been lowering its debt pretty steadily each year. So I consider its debt rating to be okay. In other words, it's still a little high than I would like to see, but the company has shown a determination to keep lowering it. Verizon does have an investment grade credit rating. The reported earnings for the company are that it's always profitable in a general long-term slow, we use the word slow a lot with Verizon, slow uptrend. Unlike many companies that I make videos about, Verizon is not buying back its shares. Like many companies that are in capital-intensive businesses, Verizon issues shares from time to time to bring in money to help it with its capital expenditures. And it did have a large increase in its share count in 2014 when it made that major purchase of buying the entirety of the Verizon wireless business. So overall, we see a mixture of some good and excellent financials along with a couple that are average. And overall, I give Verizon a B on its financials. I'll just show you one actual financial graph. It's this one of Verizon's earnings this year. I'm putting this one up because it shows what I mean by a company that is always profitable and has steady, even if not amazingly fast growth in its earnings and profits each year. Let's move on to valuation. I use 4 models to value stocks and then average the results. I'm not going to make you sit through an examination of all 4 methods I use to value Verizon, but I'm going to show you 2 of them because I can do it on one graph. This graph, which is from Fast Graphs, shows 2 of the 4 models that I use. The black line going up and down through the graph is Verizon's price per share. The blue line is a reference line for fair value of Verizon, drawn at Verizon's average 5-year PE ratio, price to earnings ratio. And the orange line is drawn at a PE ratio of 15, which is an average for the market as a whole. And you can see I drew the red arrows from the price up to both of those reference lines. You can see on this graph that Verizon's price is hanging around below both of those fair value reference lines. That suggests that Verizon's price is undervalued at the current time. And at the bottom of this graph with the yellow highlights, I indicate the change per year in percentage of Verizon's earnings per share. And I did this to illustrate what we mean by slow growth. In 2019, they went up 2%, 2020, 2%, 21 out of the box with 8%, 2022 estimate 1%, 2023 estimate 1%. That's slow, steady growth. This display summarizes my 4 approaches to valuing Verizon. The first 2, Fast Graphs Basic and Fast Graphs Normalize, are the 2 that we just saw on the price graph. I also use a method from Morningstar based on discounted cash flow, and I use what's called the yield metric, which compares a stock's current yield to its average 5-year yield. I add them up, I add up the valuation ratios that I get from that and simply divide by 4. And what I end up concluding for Verizon is that it has a valuation ratio of 0.88, which means it's 12% undervalued at the current time. If we change our look at valuation from percentages and valuation ratios to actual dollars, this is what I come up with for Verizon's fair price and what it yields at its fair price. In the middle, I show the fair price that I calculate, which is $63 per share. And at Verizon's current payout rate, that means Verizon would be yielding 4% at a fair price. To the left is what I would call a discounted price in green, which would be any price under $57 or a yield of over 4.5%. And at the right in orange, I would say don't pay over $69 a share, which would be a yield of 3.6% or less. Verizon's current price is around $55, so right now it is a little bit beneath the discounted price. In other words, I think Verizon is on sale at the moment. This slide brings together what I've been talking about Verizon. It's in the communications sector. You want to look at sectors in order to provide diversity to your portfolio. Its industry is called integrated telecommunications services. That means it's mostly telecommunications, but it's also got some content, some Wi-Fi and other elements integrated into it. Its yield is 4.5%, which is a high yield. Its 5-year dividend growth rate is just 2% per year, which would normally be considered slow. I consider it okay for a stock with a 4.5% yield. Across the bottom, we see the summaries of various categories of stock analysis that we've already seen. Dividends, I gave Verizon a grade of B. Quality, a grade of B+. Financials, a B. Valuation, 12% undervalued. All of those are green. I also took a look, I don't always do this, but I took a look at the summary of Wall Street analysts that are available from most of your brokers, and the summary from Wall Street is hold. So my view is actually more optimistic than that average rating from Wall Street, because I think Verizon is a high quality company, has a good business model, and that it's undervalued right now by a significant enough amount to make it a good deal. To summarize, I like Verizon's business model. Telecommunications is a must-have for both businesses and individuals in the current age that we live in. Verizon has survived its past flirtations with content acquisitions to focus on its core business. At the beginning, I mentioned that AT&T is reorganizing and will be lowering its dividend after the reorganization. And what AT&T is doing there is trying to clean up its flirtations with content acquisitions. It's had a couple of disastrous acquisitions, and it's spinning those out. And that's why eyes are turning their attention to a more pure telecommunications company, Verizon, with its fine yield and very safe dividend. AT&T has announced numbers that make it clear that it's going to have to cut its dividend when it finishes its reorganization. I like Verizon's valuation at $55 a share. The only thing that most investors would like to see is a faster dividend growth rate, but as I said before, that's a trade-off for the high yield and reliability of the dividend. I'm okay with that growth rate combined with a 4.5% safe yield. And that's about it. Thanks for watching. Remember to click the buttons, and I'll be back in a few days with my end of August review of my own dividend growth portfolio. See you guys. Bye.